in right at the close of 2025, and it's official now. India is the fourth largest economy in the world. India has overtaken Japan to become the fourth largest economy, with the Indian economy now valued at $4.18 trillion. That's the big story that we are bringing to you on this edition of Morning Brief at 9. Also on the show, the gig workers strike has now extended into its fourth phase, and 31st December, that's today, also happens to be one of the days that the gig workers continue to be on strike. And the union says that India cannot become, or rather Bharat cannot become Viksit unless its last mile delivery riders are included. So we'll bring you this and a lot more on this edition of Morning Brief at 9. And this is the last edition of the Morning Brief at 9 for the calendar year 2025. Thank you so much for tuning in. Let's first bring you all the headlines that we're tracking for you this morning. India overtakes Japan as the world's fourth largest economy with a GDP of $4.18 trillion and is now on track to surpass Germany within 2.5 to 3 years, with output projected to reach $7.3 trillion by 2030. IndiGo Airline receives a tax notice worth 458 crore rupees linked to compensation from a foreign supplier and denial of input tax credit. United States targets Iran's drone operations with Venezuela, stepping up pressure on President Nicolás Maduro as tensions escalate in the region. Ukrainian President Volodymyr Zelenskyy says Kyiv is discussing a potential US military presence in the war-torn country as part of future security guarantees against Russia's aggression. Mark Zuckerberg's Meta moves to acquire Chinese-founded AI startup Manus as it accelerates plans to embed advanced artificial intelligence across its platforms. Japan's SoftBank completes the second phase of its $41 billion investment in OpenAI, with stakes rising to about 11%, deepening its bet on the ChatGPT maker amid the global AI boom. Taiwanese chipmaker TSMC hits a major milestone in semiconductor technology, rolling out the next generation 2-nanometer chips crucial for AI and high-performance computing. South Korean automaker Hyundai is set to let its buyback options lapse in the Russian plant, citing continued risks from the Ukraine war and unstable operating conditions. And weight loss drug prices of pharma giants Novo Nordisk as well as Eli Lilly lowered in China as drug makers battle for share in Beijing's fast-growing weight loss market amid intensifying global competition. And the top story this morning, 2025 has been a defining year for India's growth, even as the world economy struggles to keep pace. Now, as per a government release on the 29th of December, India has officially overtaken Japan to become the world's fourth largest economy with a GDP of $4.18 trillion and is poised to displace Germany from the third rank in the next 2.5 to 3 years, with projected GDP of $7.3 trillion by the end of this decade, that's 2030. Now, the growth momentum further surprised on the upside, with GDP expanding to a 6-quarter high in Q2 of this financial year, FY26, reflecting India's resilience amid persistent global trade uncertainties. Domestic drivers led by robust private consumption played a central role in supporting India's GDP expansion. Meanwhile, high-frequency indicators point to sustained economic activity. Inflation remains below the lower tolerance threshold of the RBI of 2%. Now, unemployment, according to the government, is also on a declining trajectory, and export performance continues to improve as per the government statement. Now remember, India's real GDP grew 8.2% in the second quarter of this financial year, FY26, accelerating aggressively from the already high 7.8% in the first quarter, that's Q1, April, May and June of 2025, and 7.4% in the last quarter, Q4 of the last financial year. Now this was marked by the sixth quarter high that we saw in Q2 numbers. Now, this was also led largely by resilient domestic demand amidst global trade and policy uncertainties. The RBI had revised India's GDP growth forecast for FY25-26 upwards to 7.3% from the earlier estimate of 6.8%. India's domestic growth is on an upward trajectory owing to multiple factors such as robust domestic demand, income tax and goods and services tax rationalization, softer crude oil prices, front-loading of government capex, along with facilitative monetary and financial conditions, supported, of course, by the benign inflation numbers. Global agencies too have echoed this optimism. The World Bank has projected India's growth of 6.5% in FY26, while Moody's expects India to remain the fastest-growing G20 economy with growth of 6.4% in FY26 and 6.5% in FY27. Looking ahead, domestic drivers like favorable agriculture prospects, sustained effects of GST rationalization, inflation continuing to be low, and strong balance sheets of corporate India as well as financial institutions, coupled with supportive monetary and fiscal conditions, are expected to continue bolstering the economic activity for India. Now, external factors such as services exports are projected to remain robust, while the swift conclusion of current trade and investment negotiations offer additional upside potential. Ongoing reforms are likely to further enable growth prospects, according to the government. The present macroeconomic situation presents what the government calls a rare Goldilocks period of high growth and low inflation. On the external side too, foreign direct investment captured great momentum during the first half of this financial year. For the time frame of April to September 2025, vis-a-vis the same time period last year, gross FDI grew by as much as 19.4% to $51.8 billion. Net FDI, meanwhile, increased at a much more handsome 127.6% to $7.7 billion. The significant increase is attributed to a decline, in repatriation despite a rise in upward FDI. The government says India is on a path towards its goal of becoming a high middle-income country by 2047. But do remember, the United States remains the world's largest economy, followed by China at the number 2 position. And the nationwide strike by the platform-based gig workers has now entered a decisive fourth phase. That's right, the nationwide strike by platform-based gig workers led by Gig and Platform Services Workers Union has entered its final phase, with delivery workers across India extending their protest till today, that's December 31st. The union has submitted an urgent memorandum to Union Labour and Employment Minister Mansukh Mandavia, demanding immediate government intervention to address what it calls a systemic exclusion and exploitation of gig workers under India's labour framework. According to the union, the protest builds on last year's digital strike and reflects the platform economy's dependence on workers' labour. In its memorandum, the union warned that continued neglect of gig workers' rights could have serious implications for India's economic growth. The document said Bharat can't be Viksit until its workers, part of India's booming economy, continue to be exploited.
अपनी मांगों को लेकर गिग वर्कर्स 31 दिसंबर को स्ट्राइक पे जा रहे हैं, जिनमें ज़ेप्टो, ब्लिंकिट, ज़ोमैटो और तमाम जो ड्राइवर्स भी हैं जो कि कैब चलाते हैं, वो लोग मांग कर रहे हैं और उनकी अपनी मांगों को लेकर ये 31 दिसंबर को अब स्ट्राइक पर। हमारे साथ एक ज़ोमैटो वाले डिलीवरी बॉय मौजूद हैं, इनसे पूछते हैं 31 दिसंबर को आप लोग स्ट्राइक कर रहे हैं, क्या मांग है, क्यों स्ट्राइक कर रहे हैं?
जी सर, वो बिल्कुल होना चाहिए। ये हमारा किलोमीटर भी घटा चुका है, वो पैसे बहुत कम देते, किलोमीटर पर 1 किलोमीटर पर 5 रुपये 4 रुपये देते हैं, बहुत ही कम देते हैं। और इंसेंटिव तो बिल्कुल ना के बराबर ही कर दिया, 200 250 और 26 ऑर्डर पर हमें देते हैं वही 250 रुपये देते हैं इंसेंटिव, 12 घंटा काम करते तब वो भी।
और क्या क्या परेशानी है आपकी?
और वही कस्टमर हमारे से रूडली बात करते हैं, 10 फ्लोर पर हमें चढ़ना भी पड़ता है, 5 फ्लोर पर भी चढ़ना पड़ता है, लिफ्ट कभी कभी यूज नहीं करने देते, वो बोलते हैं जोमेटो वालों के लिए है नहीं ये चीज़, हमें यूज नहीं करने देते। वो कस्टमर जो होते हैं कभी कभी लेट हो जाए थोड़ा सा तो लेके आओ, ट्रैफिक से हमें मतलब नहीं है, हमें तो ऑर्डर से मतलब है, ये रूडली बात करते हैं वो ज़्यादातर,
मतलब बदसलूकी भी करते हैं।
जी जी जी।
ठीक है, और क्या क्या दिक्कतें हैं आपकी?
जी सर, ये सब करना चाहिए जोमेटो वालों को, और पेनल्टी हमारे ऊपर जो लगती है वो ना करे। ऑर्डर कैंसिल होता है तो तुम बोलते हो पेनल्टी लग जाएगी तुम्हारी, जितना कमाएंगे नहीं हम उतना पेनल्टी दे देंगे, तो क्या मिलेगा हमें 12 घंटा खट के। फिर
तो अभी कितना पैसा आपको मिल रहा है, कितनी सैलरी है, क्या है?
अभी तो सर ऑफर चला रखे ये नया साल का, इसीलिए, नहीं तो ऐसे नया साल के बाद फिर वही इंसेंटिव कर देंगे वो।
नहीं तो क्या अभी तनख्वाह कम है रहती है, आप लोगों को पैसे कम मिलते हैं?
वैसे ही 1200-1300 ही होता है।
स्ट्राइक सर
31 की नाइट में गिग वर्कर्स यानी कि अमेजॉन, स्विगी, जोमेटो वाले डिलीवरी बॉय पूरी तरीके से हड़ताल पर रहेंगे। उनका कहना है कि हमारे साथ मारपीट होती है और उनकी कई मांगे हैं जिसको लेकर वो लोग हड़ताल पर रहेंगे। इसका सीधा असर व्यापार पर पड़ेगा। यहाँ पर हमारे साथ बात करने के लिए व्यापारी हैं। सर, किस नाम से आपका प्रतिष्ठान है और क्या नाम है आपका?
सर, मैं वर्जेश अग्रवाल हूँ और मैं यहाँ बंगाली मार्केट में बंगाली स्वीट हाउस एंड पेस्ट्री शॉप करके हमारी शॉप है जो काफ़ी पुरानी है। एनीवे, जिस मुद्दे पे या टॉपिक में आप बात करने आए हैं उसमें देखिए, व्यापार में तो डेफिनेटली फ़र्क पड़ेगा और अच्छा फ़र्क पड़ेगा, बिकॉज 31 की ईव में हर घर में पार्टीज़ होना या जिस तरह के सेलिब्रेशंस होते हैं उन सबको देखते हुए इट्स अ वेरी सीरियस मैटर और काफ़ी मतलब दिक्कत भी होगी सभी लोगों को, क्लाइंट्स को। और एज फार एज द लाइक यू नो स्टाफ ऑफ स्विगी एंड जोमेटो आर कंसर्न, मुझे ऐसा लगता है कि पर्सनली कि अगर उनकी मांगे हैं तो दे शुड हैव डन इट इन अ मोर ग्रेसफुल वे।
Meanwhile, all those planning New Year's Eve at home may have to rethink their delivery options. Well, moving on now, the airline operator IndiGo, the part of Interglobe Aviation, has received a GST penalty notice worth over 458 crore rupees on Tuesday, December 30th. The GST penalty notice has been issued for financial year 2018-19 to 22-23. According to Interglobe, the GST department has passed an order imposing GST demand along with interest and penalty on compensation received from a foreign supplier and denial of input tax credit. The company, in a regulatory filing, said it strongly believes that the order passed by the GST department is erroneous and not in accordance with the law, backed by advice from external tax advisors. It further said that the airline will contest the order and will take appropriate legal remedies against the aforesaid order. The company is already in the appeals before the Commissioner appeals in a similar matter for FY 2017-2018. In a separate filing, IndiGo also informed that it has received another GST penalty notice from Lucknow's Joint Commissioner Office worth 14.6 lakh rupees for financial year 21-22. The airline, however, said that there is no significant impact on financials, operations or other activities for the company. All right, time for a very short break, but coming up on the other side, global stories from around the world as we close 2025. You're watching Morning Brief at 9.
(2026) Take notes. Manifesting. For my little Miss Sunshine. Tickles and giggles. Also wanna be a biker chick this time. And dear 2026, only love for my people. And myself. To manifest my best life. Nature's cosmic energy.
Now mine. Natural diamond intention pendants.
पेंटिंग में पहली बार बिरला ओपस एश्योरेंस। 1 साल में पेंट को कुछ भी हुआ तो पेंटिंग वापस करके देंगे। रजिस्टर करो birlaopus.com पर।
सन डायरेक्ट लेकर आया है एक जबरदस्त नया टीवी पैक। यहाँ असली 2 साल का निवेश, 100+ चैनल्स, HD क्वालिटी बॉक्स और रिचार्ज की टेंशन 2 साल के लिए खत्म। तो अभी लगवाइए सन डायरेक्ट, यहाँ खर्चा नहीं, 2 साल का असली निवेश।
सन डायरेक्ट सब्सक्रिप्शन पाने के लिए अपने नजदीकी रिटेलर से जल्द ही संपर्क करें और घर पर सन दनादन।
Every brand tells a story. And they are the storytellers. The Sutradhars. They present a brand with band, baja and barat to you. They are the Brandwalas.
Back, you're watching Morning Brief at 9. On to stories from around the world now. Ukrainian President Volodymyr Zelenskyy said on Tuesday that Kyiv is in talks with Washington over the possible presence of US troops in Ukraine as part of future security guarantees. Zelenskyy also addressed Russia's claim of an attack on President Vladimir Putin's residence, calling it a fabricated incident aimed at undermining ongoing peace efforts. The remarks come amid heightened tensions and sensitive negotiations over security arrangements and a possible path to ending the war. Take a look.
Ukrainian President Volodymyr Zelenskyy told media in a WhatsApp chat Tuesday that Kyiv was discussing with Washington a possible presence of U.S. troops in Ukraine. He said it would be a major security boost as part of a peace deal with Russia. The White House had no comment on the issue of dispatching U.S. troops to Ukraine. Meanwhile, Russia said Tuesday its negotiating stance would toughen after it accused Ukraine of attacking one of Putin's Russian presidential residences. The Kremlin provided no physical evidence of the alleged incident. Zelenskyy called the claim a complete fabrication intended to justify additional attacks against Ukraine. He did say he was committed to continuing talks on how to end the war, triggered by Russia's 2022 full-scale invasion, and was ready to meet Putin in any format. U.S. President Donald Trump said on Sunday he and Zelenskyy were maybe very close to an agreement to end the war, although thorny territorial issues lingered. He was more cautious than Zelenskyy on security guarantees, but said they were 95% of the way to such an agreement, and that he expected European countries to take over a big part of that effort with U.S. backing.
All right, tech giant Meta on Monday announced it will acquire Chinese-founded artificial intelligence startup Manus, stepping up its push to embed advanced AI tools across all its platforms. Manus drew global attention earlier this year after it went viral on X following claims that it had developed the world's first general artificial intelligence or AGI agent, a software designed to make decisions and execute tasks autonomously with minimal human prompting.
Meta said it will buy Chinese-founded startup Manus as the tech giant accelerates efforts to integrate advanced AI across its platforms. Financial terms were not released, but a source told Reuters the deal values Manus at between $2 and $3 billion. Manus went viral early this year on X after it released what it claimed was the world's first general AI agent, capable of making decisions and executing tasks autonomously with less prompting than ChatGPT and DeepSeek. The company was cheered by Chinese state television, with commentators calling it China's next DeepSeek. Months later, Manus moved its headquarters from China to Singapore, joining a wave of other Chinese companies that have done so to curb risks from U.S.-China tensions. Its products are not available in China. Tech giants such as Meta have been ramping up AI investments through strategic acquisitions and talent hires as they navigate fierce industry competition. Manus did not immediately reply to a request for comment.
And staying with the theme of artificial intelligence, Japanese tech investor SoftBank said on Wednesday that it now holds around 11% stake in OpenAI after completing the second stage of a massive $41 billion investment in the maker of ChatGPT. The move underscores SoftBank founder Masayoshi Son's decisive pivot towards artificial intelligence following years marked by both outsized gains and steep losses across the group's global investments. Now, SoftBank had announced in the month of April that it plans to invest up to $40 billion in OpenAI. The company said the second tranche of $22.5 billion has now been completed, taking the total investment to $41 billion. Now, of that amount, $30 billion came from SoftBank's Vision Fund, with the remaining $11 billion contributed by third-party co-investors. SoftBank and OpenAI are also partnering with Oracle on a $500 billion Stargate project aimed at building large-scale AI infrastructure in the United States, an initiative announced by US President Donald Trump in Jan 2025. Separately, SoftBank said that this week it is acquiring US data center investor Digital Bridge in a deal valued at around $4 billion, further deepening its push into AI-linked infrastructure. And Taiwanese chip giant TSMC has begun mass production of its next-generation 2-nanometer chips, marking a major milestone in the global semiconductor race. The world's largest contract chip maker said its 2-nanometer technology entered volume production in the fourth quarter of the calendar year 2025 as scheduled. The company described the chips as the most advanced in the industry, offering higher density and significantly improved energy efficiency. TSMC said the new technology uses a nanosheet transistor structure, delivering major gains in performance and power efficiency critical for next-generation compute as well as artificial intelligence. Taiwan manufactures more than half of the world's semiconductors and almost all of the most advanced chips used in AI systems. The boom in artificial intelligence has made TSMC one of the biggest beneficiaries of soaring global tech investments. According to US research firm Gartner, global AI-related spending is expected to reach $1.5 trillion by the end of this year, which we closed today, and exceed $2 trillion in 2026, nearly 2% of the global GDP. Taiwan's dominance in advanced chipmaking is widely viewed as a strategic silicon shield, strengthening incentives for the United States to protect the island amid tensions with China, which claims Taiwan as its own territory. South Korean automaker Hyundai is likely to repurchase its former manufacturing plant in Russia, likely due to the ongoing Ukraine war, according to a source familiar with the matter. Hyundai is reportedly not in a position to exercise its buyback option, which is set to expire next month, citing ongoing geopolitical and operational risks which are linked to the ongoing conflict. Take a look.
Hyundai is not in a position to repurchase its former manufacturing plant in Russia due to the continuing war in Ukraine, a source familiar with the matter has said. The South Korean carmaker sold the St. Petersburg factory, one of Russia's largest foreign-owned car plants, in 2024. Operations at the facility had been suspended since March 2022, a month after Moscow's invasion of Ukraine. The deal saw Hyundai sell 100% of the facility to Russia's AGR Automotive Group for a symbolic 140,000 won, or $97, in 2024. It included a 2-year buyback option, and that clause expires in January. Hyundai told Reuters in a statement that a final decision has not yet been made on the buyback option. AGR Automotive Group did not respond to a request for comment. Though the source did not elaborate on the specific reasons the company could not act on the buyback option, they pointed to the ongoing conflict in Ukraine. Hyundai and affiliate Kia were the biggest foreign players in the Russian car market before the Ukraine war. Together, they sold more than 400,000 cars in 2019, accounting for nearly a quarter of all new car sales and ahead of Russia's largest car maker, Avtovaz.
And with that, we will slip into another short break. But coming up on the other side, the most definitive investor's guide. We have three very special guests joining us to tell all of us and our viewers what should be the best investment strategies and redefine asset allocation for 2026. You're watching Morning Brief at 9.
Delhi is losing the fight against pollution.
This is not a story of just children. This is the story of every elderly person in the National Capital Region.
Delhi's hazardous air quality.
It's more capital of the world.
Delhi pollution has left us sick and exposed, also frankly embarrassed.
Hazardous air quality are disrupting daily life.
Growing issue of a toxic air looming large over Delhi.
Delhi's air quality index has been hovering between 300 and 400 for the past week.
The culprit was the same PM 2.5, the main pollutant which is emitted from heavy industries, power plants, vehicles, crop burning and coal-based heating.
The overall air quality of the city continues to remain in the very poor category.
We look at how Delhi is once again struggling with danger.
It's not just about today, it's about the future.
Hello and welcome. You're watching this very special coverage that we are bringing to you right as we close 2025 and step into 2026. And the big question on everybody's mind really is, what should my asset allocation be for this year? Remember, 2025 was fraught with massive volatility on the stock markets. In fact, after the highs that we saw on the Sensex and Nifty in September of 2024, it took December of 2025, a good 1 year and 3 months later, for the Indian stock markets to touch those new lifetime highs before slipping again towards the end of the year. So it has been a volatile market. It has been a volatile session for investors who have been looking at their retail portfolios on the stock markets and the SIPs and mutual fund portfolios that they hold. So the question really is, what should their asset allocation be? Should they continue with their mutual fund investments? Is SIP the right way to do it? Should they look at perhaps increasing the load of silver and gold in their portfolios because of the rally that we've seen recently? Or is it best not to fret about anything? Let your investments be untouched. Continue sip by sip. Go ahead and grow your portfolio. Well, we'll try and get you all the answers, as many as we can, with a very special set of guests who are joining us this morning. We have with us our regular friend at News9, Mohit Gang, co-founder and CEO of Money Friend. Thank you so much, Mohit, for your time. We also have Shweta Rajni, mutual fund head at Anand Rathi Wealth, and we will soon be joined by Nasir Salim, managing director of Flexi Capital. First up to you, Mohit. Just help us understand the kind of volatility that we saw in the stock markets in 2025. And I'm talking about the lows that we hit soon after Donald Trump announced on April 2nd the tariffs. And I remember 7th April was the day that the Indian stock markets had hit their pretty much 52-week lows. And it took all of December, until December, to come back to reclaim those levels. So investors looking at their portfolios were pretty upset through the entire calendar year of 2025. What would be your first and foremost advice to retail investors as they step into 2026? How should they look at their investments?
Thank you so much, Karthik. First of all, wishing you and through you, all your viewers, a very happy and a prosperous 2026.
Thank you so much, Mohit, and likewise to you as well.
Thank you. And as we draw curtains to 2025, Karthik, I think it's always good to take away some lessons. And to me, I think the key lesson, the way the market taught us, from September 24 till date, we are just about trying very hard to capture that peak, right? Through the complete year, market has given us movements and opportunities to dive into it, to kind of top up our investments. April 7th precisely was that day when the markets, I think, kind of hit a low of 21,800 on Nifty. Right. So if anyone was smart enough to take plunge at those opportune moments, I think he or she has gained tremendously in the portfolio. Having said which, at a broader level, it's been a phase of time correction in the market. Value wise, we haven't corrected much. Honestly, if you see a 5-10% or a 15% drawdown is not like earth shattering in today's time and era. So we haven't corrected a whole lot on the value front. If you see the playbook for the year, large caps have kind of stood the ground. Nifty at a broader level, Nifty 50, Nifty 100 at a broader level has kind of delivered a single digit return of around 7 to 9%. Mid caps also have just about delivered around 5%, but the small caps have corrected dramatically. The index is down almost 8 to 9%, but at a broader level, there are stocks which have gone through massive amount of correction, right?
Right.
So I think for investors, it's been a year of lessons that you have to stay your ground, you have to hold up to your convictions in the stock market, and there could be dull phases and long dull phases of time correction.
Right, so there could be these dull phases, and like we've seen, 2025 pretty much was a fairly long period of dull moments. But Shweta, if I can come to you, I want to understand that, you know, many people out there, experts out there, market veterans out there say that there's a strategy of buy on dips. But most retail investors who are taking the mutual fund route may not really subscribe to that strategy. So should SIP as a tool be something which the investors, retail investors, should never discard come what may, no matter how high the market is, no matter how low the market is? Because sometimes that temptation is there to maybe pause the SIPs, withdraw some money and make a lump sum investment at a time when markets are low. But you don't know what the bottom really is, do you?
Hello, good morning, Karthik. Firstly, Happy New Year to everyone. Like you said, see, it's not easy to identify which is the low and what is the peak level. So the strategy for making money in the long term is stay disciplined, stay invested, and continue with your SIPs and hold it on for a longer time period. The compounding plays out. The basic principle always works. And I want to highlight a study that we had done for someone, let's say, who was for the last 10 years an unlucky investor and invested always at the peak of that year. Even in that circumstances, if he stayed invested for 10 years, the minimum return that the investor would have made would be 10%. And for someone who did not bother about market timing, bothering about the peaks or the low, just continued with the monthly SIP and did that for a 10-year period, ended up with somewhere around a 13% return, which, the 3% compounding benefit that you get is as good as your principal value coming back to you extra. So, my suggestion to everyone and a strong recommendation is, irrespective of where the market is, as long as you have the money in your bank account and it is supposed to go into equity, you should continue with SIPs, not bothering about where the market level is. The characteristic of equity is also such that, it would rebound on its own. The mean reversion plays out. So, don't get worried about how much has the market corrected. Did you miss out on the bottom level? Continue with your SIPs. And I think retail investors have shown that because, where do we see SIPs? They've actually gone up over the last few years, and we are very close to touching a 30,000 number.
Right, absolutely, except for the month of November where we saw a slight dip from what we had seen in October. So you could sense that perhaps there are some investors who are feeling the jitters of markets not climbing as they might have expected. But I will come to you again, Shweta, with your sort of, advice on what kind of mutual funds should investors look at in 2026. But right now, let's welcome Nasser Salim, Managing Director of Flexi Capital, who joins us here this morning. Nasser, thank you so much for your time. I want to understand from you that, the traditional asset allocation formula that a lot of us have become accustomed to is the 70-20-10 principle of 70% equity, 20% debt, and 10% could be gold. But I think the kind of numbers that we've seen in 2025 make many investors rethink that what if that 10 attributed to gold should expand to a lot more and potentially add not just gold but other metals also in the mix. So do you think that that asset allocation traditional formula needs a relook at in 2026?
Good morning, Karthik. Wonderful to be on TV9. I think, you guys are doing a great, wonderful job. And to all your viewers, wish them a very, very happy new year. So, to Karthik, to your original question and your point, see, the asset allocation in 2026 is a very broad-based question, right, Karthik? But yes, the answer is slightly. I think it does require some changes. 2025 was a volatile year, Karthik. 2026 is going to be, it's actually expected to be more stable as compared to 25. Stable in terms of returns, driven mainly by company earnings rather than valuation in jumps. We suggest staying balanced across fixed income, debt, as I said, gold and equity.
Yeah.
A lot of our investors today have forgotten the concept of asset allocation, especially in terms of fixed income and debt.
Okay.
And multi-asset investing is still the safest approach that we recommend and continue to be overweight on.
Okay.
I think in simple terms, Karthik, keep equity as your main engine.
Right.
That's going to be the growth of your portfolio.
Uh-huh.
You can add a bit of debt for stability.
Right.
You add some gold as a long-term hedge and inflation, rather I would say as insurance in the portfolio, and that is what we would recommend from an asset allocation perspective. Also, I think what's more important within asset allocation is also your individual risk profile, right, and your investment horizon. I think both these three things combined will determine stable returns in 2026.
All right, so that is the formula coming in. Well, not much change because equities should continue to be the large portion, the lion's chunk of your investments. But Mohit, if I can bring you back into this conversation, once upon a time we used to talk about goal-based investing, and a lot of advisors out there used to say that, hey, you should know what your goal is, what you're investing for, and then closer to completion of the goal, you should quickly rebalance your portfolio or take a safer bet. But in your experience, are investors, retail investors, indeed doing goal-based investing? And is that something that they should do? Because eventually, the goal, no matter what, boils down to the fact that you want your wealth to grow. So is goal-based investment really as relevant today in 2026 as it was perhaps 10 years ago when, let's say, real estate prices were a little lower? It was easier to plan for your life because you didn't know the kind of, rally real estate is going to see and the kind of rally education prices are going to see.
Karthik, look, I think I've spent almost 23 years now doing this profession, which is managing wealth for clients, right? And very rarely have I come across a breed which completely relies on goal-based planning and goal-based asset allocation and everything.
I thought as much. It seems quite counterintuitive. Only if people were so clear in their minds of what they want the money for. Everybody just wants money.
No, I think, and my dear friend Nasser is out here. Perhaps he can vindicate that, right? So, but look, honestly, I think it's a good theoretical practice. It's good on books. It goes on good on media. It sounds great in practice, but in reality, when it comes to each one of us, like all four of us out here on this panel, I'm not sure how many of us are actually doing a goal-based, have 5 goals aligned, and have 5 different kind of strategies following and chasing those goals, and perhaps building up our portfolios and tracking those goals every quarter, every 6 months, and seeing how it works. It works brilliantly if you're really doing it.
Yeah.
In practical aspect, what I've seen is people typically build for their retirement and long-term wealth creation. And in the interim, if they have any goals, they kind of have drawdowns from those buckets or those basket itself. Very rarely have I seen different baskets for different goals. Though, yes, that's an advisable practice. And I would still love that most of the investors follow it. Perhaps from 2026 onwards, if most of the people can expand the horizon for what they're investing into different baskets and categorize it clearly so that each basket can then follow a different risk pattern and a different asset allocation. I think that works brilliantly. But again, as I said, it's too much of a work and too much of a tracking. And for an individual, it's very difficult to do it on himself by himself or herself. So perhaps you need a good financial planner by your side to carry you through that journey, right? So, but otherwise, even if you're planning from a long-term perspective for wealth creation, for your retirement, and then drawing down on your goals as and when needed, I think that itself is a good path, honestly. And if you're doing that basic, you are well on your path of financial freedom. So you need not be like really doing a lot on this one.
All right. But of course, like you rightly mentioned, it is important to seek professional financial advice and have somebody with the right credentials by your side to help you plan how you can potentially expand your wealth, no matter whether the goal is clearly defined or not. But Shweta, if I can bring you back into this conversation, there's often this debate between mutual funds. It's so much clutter. The fact that retail investors must rely on somebody to tell them which mutual fund to buy, when you have options like, let's say, Zerodha, Grow, all these low discount or zero discount brokers, which have pretty much, on the click of one button, all the options listed down for them. So for the retail investor, let's say starting off his journey of investing in 2026, wants to just put 10,000 rupees, 15,000 rupees every month aside, doesn't want to take the pain of going through financial advisors to select maybe, those 3 or 4 SIPs that he or she wants to do. What is the best, simplest tool for somebody who's starting out in 2026 to make those DIY investments on any one of these platforms?
Sure. So, firstly, it's always a debate between cost versus value, because a lot of these platforms give you investments available at a cheaper cost.
Right.
But my recommendation here would be that wherever the value that can be created by an advisor is significant, you should seek that advice. And I'm just going to quote some numbers here. So over the last 15 years, if you see the best versus the worst mutual fund, the differential in return could be as high as 50% per annum. And that's a huge difference. It's not like, you're going and buying a term plan where the difference could be hardly a few hundreds of thousands. Here, the value can be very different. So seek advice for long-term wealth creation. However, if you are still in that early phases, it's good to have a combination of a flexi cap fund, which can be a replacement to a large cap fund for you. Flexi generally as a category does better than large over longer time periods. So one flexi cap fund, one mid cap fund, one multi-cap fund, which can substitute for a little bit of your small cap exposure over there.
Okay, just for our viewers, Shweta, if I can request you for our viewers, just break it down. A flexi cap is what? It gives you the flexibility of large as well as mid-cap stocks, or does it give you flexibility of equity and debt? Just break it down for our viewers. What exactly is a flexi cap that you're recommending?
Sure. So, there would be in the equity mutual fund category, a large cap fund category, which puts almost 90% of their money in the top 100 companies, which are defined as large cap.
Right.
On the other hand, you will have something like a flexi cap fund category, where the SEBI has not defined any rules. The fund manager has full flexibility to do whatever he wishes or she wishes to buy for the company, for the investor. Right. But generally, we have seen flexi cap funds also tend to have a large cap bias in their portfolio, and anywhere between 65 to 75% is large cap oriented.
Right.
So for someone who wants a large cap exposure, a flexi cap fund we've seen historically have done slightly better than a pure large cap fund. Okay. So it's very important in a portfolio that you have a good mix of large cap, mid cap, and small cap. So therefore, I'm saying for a large cap exposure that one would need, and if you just want 4 funds, go in for one flexi cap fund.
Right.
The other category that I was referring to is a large and mid cap category, which has a combination of minimum 35% being in large caps, the top 100 companies, minimum 35% being in mid caps, which is the next 150 companies by size. Mm-hmm. The rest of it is the flexibility to the fund manager. So have one of your large and mid cap funds, one have a pure mid cap fund in the portfolio, and the 4th fund that you have now, depending on your risk appetite, you can either have a multi-cap fund, which would give you some maybe 25% odd exposure to a small cap, because a multi-cap category is one where you need to have minimum 25% each in large cap, mid cap, and small cap. So in a way, it gives you exposure to all the 3 categories.
All right.
Or you can go in for a pure small cap fund, where you will at least have 70% odd of the money getting invested in a pure small cap. So if you do a combination of all these, effectively, you're getting roughly around 50-55% exposure to a large cap, which is good because you need some stability. And you're having a 45% odd exposure to mid and small cap, which gives you that extra return kicker that you may need on the portfolio while balancing the risk for your entire, 10,000 rupees SIP that you may be doing.
All right, Shweta, thank you so much for breaking that down. But Nasir Salim, for the slightly more evolved investor out there who's watching us today, help them understand, because there is right now a lot of conflict in their minds that, hey, should I continue with my SIPs in mutual funds, no matter whatever category I'm invested in, or should I rather look at the gold and the silver ETFs, which have given tremendous returns in 2025?
So, Karthik, again, a very pertinent question. And I think, we've seen, with both the metals, gold and silver, the way there's been a euphoric rise.
Yeah.
And now my worry, and I must say this on your show, on your channel, is my worry is now about FOMO steeping in and coming in, especially on silver, right? So, look, it's always a good idea to diversify your asset class, your product mix, and continue to invest them in a disciplined manner, which is through SIPs and in a more disciplined manner, which is the right way to go. So for long-term creation, diversification may work very well, but to chase momentum is where the big risk comes in, right? I think today, if you look at as far as the Indian landscape is concerned for the global, in terms of the capital markets are concerned, India is expected to do well in 2026. There is expected to be a good earnings upgrade. Those need to start showing up, and therefore, SIPs to continue broader, outweigh to Indian markets and to Indian funds is something which is good.
Yeah.
Gold, as I told you, from an SIP perspective, continues to be looking okay. We're not too worried about that. But I think even silver, long term is fine. But the way we are chasing momentum and the way we are chasing these asset classes, I think that is definitely something to worry about.
Okay.
And the only way to do this is stop chasing greed. There are two very important emotions, Karthik: greed and fear.
Correct.
We need to strike the right balance between the two. I think for investors looking at larger wealth creation, SIP could be a very good tool, is a very good tool rather. We've seen that and witnessed it over the last few years. But clearly, the recommendation is stop chasing momentum, because that's where real investors get caught each time and every time, and history repeats itself.
Absolutely.
So,
and we've seen that even with the FNO segment, we've seen greed. And like you rightly mentioned, Nasir, it's not just fear and greed. I think this entire momentum is something that investors should be wary of. But Mohit, let's pivot now to the even more evolved investor who has a lot more money than, the youngsters out there who may be beginning their investment journey in 2026. And help us understand this new asset class of SIF. Who is that asset class meant for? Which are the kind of investors who should take exposure in the SIF category?
Yeah. So look, Karthik, specialized investment funds is a new category which SEBI has come up with, and I think this is a path-breaking, revolutionary kind of an asset class which SEBI has introduced, because it comes under the umbrella or the overall banner of mutual fund industry.
That's
which
right.
Kind of enjoys trust of crores and crores of investors, right? So, and a PMS or an AIF might seem like a risky investment, might seem like a risky bet to many, and it's not easily accessible. The right amount of information, the right amount of disclosures, the transparency, I think everything, when you put together, there is still a lot of mysticism around the PMS and the AIF industry. I think to declutter that, SEBI has kind of come up with this category which starts at a 10 lakh ticket size. Each AMC is supposed to launch its own brand under a new umbrella. They will come up with these specialized investment funds for investors who are looking for aggressive returns, right? So I think the key word out here is, Karthik, investors should not confuse it with the regular mutual fund schemes. These are not funds which are meant to go by the normal playbook. They have higher exposure of derivatives to certain extent. If they are in the credit category, they will go for lower credit quality papers, so on and so forth, right?
Okay.
So investors have to be aware of the risk, but the whole idea out here is to evolve investors who have tasted the mutual fund well, who have a large enough portfolio, who have a large enough experience in mutual funds, and if they really want to cut it out, and before getting into the PMS and AIF kind of products, they want to taste what it actually looks like at a lower
Yeah.
ticket size, this is meant for those kind of investors.
All
So you
right.
come in at a 10 lakh ticket size and you taste what the world of aggressive investing looks like with derivatives, with credit papers, with hedging, with all those kind of sophisticated investment toolkits. I
Right.
think it's meant for those kind of investors.
So define that investor to be, Mohit, because if let's say if somebody has a mutual fund sort of outlay or a total net value of their mutual funds at, let's say, 1 crore rupees, is it safe for them to take out that minimum threshold of 10 lakhs and invest in in this new investment tool? Or do you think we are looking at even a more wealthier sort of class of investors, and then they should maybe take just a 2%, 5% exposure of their total net worth and put that in SIF? Which kind of an investor are we talking about here?
That's a pretty pointed question, Karthik. But yeah, I think to me, any investor portfolio 2 crores and above, which will mean that at least a 5% exposure is given to this new asset class to start with. I think that's the right starting point for me. Look,
Right.
each one can define their own risk appetite, and there could be investors who can take the threshold up or down as the case may be. But I think 2 crores for an SIF, a 5 crore for a PMS, and a 10 crore for an AIF. To me, that seems like the right threshold to get into these kind of products if ever any investor wants to get in. And also, at least 5 to 10 years of experience behind you in investing. So it doesn't matter whether you start with if you're starting today with a 5 crore portfolio, then the category is not for you. You have to first start with the basic, go the entire grill, do the mutual funds, go through the cycles, 2-3 cycles, learn the pain, learn the pleasure part of it, and then perhaps get into it. So my sense is a minimum 5 year of experience of prior investing in mutual funds is also a precondition.
Fantastic, Mohit. Thank you so much for that input. And I'm sure a lot of investors out there who are looking at these numbers and are confused. Hey, should I do SIP? I have 10 lakh rupees. Should I do SIF? I think that risk and that experience of having seen those gains and pains, like you mentioned, is absolutely relevant. Nasser, I want to come to you with another investment class which we haven't spoken about too much all of 2025, and that's because the prices really went through the roof, quite literally. And I'm talking about the roofs of the real estate prices across India. So real estate was also to some seen as a very stable investment decision, which is going to return your capital and make you see great gains, in years to come. But is the real estate market too overheated from what you saw in 2025 for people to make those investment bets? And I'm talking pure investment, not buying houses to live in, but buying houses to invest or piece of land to invest. Is 2026 already too late to make those investment decisions?
Karthik, again, a great question, but very, very pointed, I must tell you. So, clearly, as far as real estate is concerned, see, look, from an investment perspective, clearly, and not from, as a real estate, physical purchase perspective, I think it is still good, but one has to be very, very selective. I think broadly, all your viewers understand this, that average rental yields in India are around 5% as far as, residential yield is concerned. Commercial real estate on the other end, again, depending on which cities, one, for example, you choose, Hyderabad, Bangalore offers as high as 7 to 10% yields on commercials, right? In simple terms, Karthik, it's if only the location is strong. There are very micro pockets also for investing, right, as far as real estate is concerned. But if you want liquidity plus rental income, then there is a category as far as investments are concerned. Those are called REITs, right, which are a very simple way for participation. Now, the challenge is that in India, we don't have too many REITs being offered from mutual funds. So, as I completely agree with my fellow panelist, Mohit, and a dear friend, knowledge and experience, again, on real estate is something which is very, very important before we get into it. And an experience before, in terms of when you're looking at the financial aspect of investing in real estate. So clearly, I think there is a category called REITs. Yeah. There are very, very few REIT options available right now. And again, the ticket sizes there could be very high. They're not as low as, mutual funds or SIFs, for example.
Right.
And that is where we need a lot of knowledge and experience. But to answer your question simply, please identify if it's a real estate purchase for investing, please identify the opportunity in terms of the location that it offers you. The large expectation is broadly between 4 to 5% on a good micro mini market in residential, And in commercial, there are certain micro markets which give you options as high as 7 to 10%. Please understand that there is a taxation impact also in real estate.
Right.
And then there are these which also have their own taxation impact, and they're not as simple as getting into a mutual fund with equity. So those are some of the things that at least I would allude to.
All right, Nasir. And final word to you, Shweta. We are just about a month away from the Union Budget 2026. And I think one key demand has always been on the, not just the security transaction tax, but also lowering the long-term and the short-term capital gains tax. So purely from a mutual fund industry perspective, is there an expectation you have from the finance minister to deliver on the taxation front when it comes to mutual fund investments?
Yeah, Karthik, honestly, that's always on the wish list to have a lower taxation as far as equity is concerned, as well as on the debt side. Because, given where you see, if you look at India's household savings today, we are only out of the financial assets, 15% invested in equity. And that's the asset class which can actually give you a higher return. But so, while as the industry would want the tax rates to come down, we've just seen that government is increasing the tax rate there. So we don't expect too much changes in the capital gain tax as of now, while it will be there on the agenda as a wish list from the industry.
All right. Well, let's leave it at that. And thank you so much. I would like to thank Mohit Gang, Nasir Salim, as well as Shweta Rajni for their time and for joining us on this very special occasion. And I wish all of you, like all our viewers, a very, very happy and prosperous 2026. Thank you so much for your time. And with that, we come to an end of this special edition. Thank you so much for watching. But news continues right here on News 9.
This is India's #1 news network, and you're watching News 9, English news as it should be.
This isn't a trail of peace. This is pressure overload. A hill built for 1,000, forced to carry lakhs.
Instead of lightening the footprint, you have allowed people to actually get into every nook and corner of the Himalayas.